Welcome back to our channel. And today, we have a special video discussing the reasons behind the recent panic on Wall Street. October has a long history of spooking investors, and this year is no exception. Let's dive into the details. On Tuesday, the Dow Jones Industrial Average saw a sharp decline of 454 points, marking its biggest drop since March. The Dow's biggest drop since March is a sign that the stock market is still volatile and that there is uncertainty about the future of the economy. This recent turmoil has left investors concerned about the market's performance in the remainder of 2023. The CNN Fear and Greed Index, which tracks 7 market indicators, recently plunged to an extreme fear reading of 14, the lowest since last October. This indicator reflects the heightened anxiety among investors. One major factor contributing to the anxiety is the surge in corporate debt sales and rising bond yields. Elevated government bond yields have historically been a sign of trouble for stocks, as they offer investors higher returns on safer assets. There are a few reasons why rising bond yields could be negative for stocks. First, it makes it more expensive for companies to borrow money, which can weigh on their profits. Second, higher bond yields can make stocks look less attractive to investors, as they offer a lower potential return. Third, rising bond yields can lead to a sell-off in stocks, as investors move their money to safer assets. The surge in corporate debt sales is also a cause for concern, as it suggests that companies are struggling to raise money from other sources. This could be a sign of economic weakness, which could also lead to a decline in stock prices. Investors are understandably anxious about the impact of rising bond yields and corporate debt sales on the stock market. However, it is important to remember that the market is cyclical and that there will always be periods of volatility. Additionally, stronger than expected jobs data has raised concerns that the Federal Reserve may decide to keep interest rates higher for an extended period. This is because the strong jobs data suggests that the economy is still growing and that inflation is not under control. As a result, the Fed may feel the need to continue raising interest rates in order to bring inflation down. High interest rates can eat into corporate profits and drag down stock values in a few ways. First, they make it more expensive for companies to borrow money, which can reduce their profit margins. Second, they can lead to a slowdown in economic growth, which can hurt demand for companies' products and services. Finally, they can make stocks less attractive to investors, as they offer a lower potential return than bonds and other fixed-income investments. However, it is important to remember that the market is cyclical and that there will always be periods of volatility. Adding to the volatility is the political chaos in Congress. Just last weekend, there was a narrowly avoided government shutdown over the fiscal budget. The recent ousting of Speaker Kevin McCarthy from his role has further amplified uncertainty. A government shutdown would have had a significant negative impact on the economy and the stock market. It would have caused millions of federal workers to be furloughed or laid off, and it would have disrupted government services across the board. This would have led to a decline in economic activity and a decline in corporate profits. The ousting of Speaker McCarthy has also raised concerns about the future of the Republican Party and the ability of Congress to pass legislation. This uncertainty could weigh on the stock market, as investors may be less likely to invest in companies if they are not sure what the future holds. Moody's, a major credit rating firm, has warned that a government shutdown would be credit negative for the United States, potentially triggering a downgrade. Approximately 43 million Americans will face their first student loan bill since 2020 in the coming weeks. According to the Federal Reserve Bank of New York, the average student loan payment is $393 per month. For many borrowers, this is a significant financial burden. This could potentially limit consumer spending, which is a vital driver of economic growth. Geopolitical risks remain elevated as Russia's war on Ukraine continues, and tensions between the United States and China persist. High oil prices also add to the global uncertainty. The war in Ukraine is having a significant impact on the global economy. It is disrupting supply chains, causing energy prices to rise, and leading to food shortages. This is putting pressure on businesses and consumers around the world. The tensions between the United States and China are also a major concern. The two countries are the world's two largest economies, and a trade war or other conflict between them could have a devastating impact on the global economy. High oil prices are also a concern. Oil is a critical commodity, and it is used in a wide range of products and services. High oil prices can lead to inflation and a slowdown in economic growth. These geopolitical risks are creating uncertainty and volatility in the stock market. Investors are concerned about the potential impact of these risks on corporate profits and economic growth. As a result, they are less likely to invest in stocks. October has a notorious history of stock market turbulence. Events like the 1929 Black Tuesday, 1987's Black Monday, and the start of the 2008 financial crisis all occurred in October. This has led to the belief in the October effect. However, historical data reveals that October hasn't always been a month of doom. In fact, it has also marked the beginning of major stock market rallies, such as Black Monday and the recovery after the dot-com bubble burst. For long-term investors, like many of us, it's important to remember that market fluctuations are a part of the game. Predicting short-term market movements is incredibly challenging. Instead, focus on a long-term investing strategy. Remember the age-old saying, time in the market beats timing the market. Embrace volatility as an opportunity to buy attractively valued companies. In conclusion, while Wall Street may be experiencing turbulence in October, it's essential to keep a long-term perspective in mind. Don't let short-term fears dictate your investment decisions. Stay focused on your long-term journey. That's it for today's video. If you found this information helpful, please hit the like button, subscribe to our channel, and don't forget to ring the notification bell to stay updated with our latest content. Thank you for watching, and happy investing.